we really thank everyone for being here. Obviously, this is our annual DC Fest celebration. The good news is once you're invited once, you're invited for life. So you're lifelong members. But this is the first year where we wanted to have a breakout session on all things healthcare, regulatory. Obviously, with this new administration, they've made it very easy to predict the future, very stable, clear visibility to all things. But we're excited because we have an exciting panel that's joined us. I'm going to let each of them introduce themselves, starting with my colleague, Aaron Newman. But I'm Hector Torres. I think I know all of you, but I'm a managing director. I have the privilege of advising both in the U.S. and globally on all things healthcare services and providers. With that, Aaron, why don't you introduce yourself?
Sure, yeah. Thanks everyone for coming today. Aaron Newman. I'm a director at DC Advisory. Joined the firm about 3 years ago to help start the U.S. healthcare practice. Primarily cover healthcare services focused on post-acute and primary care and women's health. Look forward to the conversation today.
Hi, Ken Marlow with McDermott Will Emory. I've been practicing for about 30 years exclusively in healthcare mergers and acquisitions, mostly on the provider side, but also in life sciences as well. Our firm specializes in all things healthcare and healthcare transactions.
Hey, good segue. Ken and I are bros. I am Brian Fortune. I run the Farragut Square Group. I worked on the Hill for House Leadership for a decade, then started the Marlow Group, which a lot of people know, as well as Farragut. Then I started Farragut Square about 12 years ago, and then in 2019, we got acquired by McDermott Will Emory, so we're part of the empire. We do it's a big, beautiful empire. I do M&A support, diligence across the entire healthcare universe, pretty much all the way from payers through provider types. The waterside is kind of drug development. We don't do as much drug development, although our McDermott friends do a lot of life sciences deals. That's the short commercial.
Thank you, Brian. I'm Manish Gupta. I'm a managing director with DC Advisory. I focus on medical products and sort of related services around the product ecosystem. So think about medtech OEMs and then supply chain going into the OEMs, which would be contract manufacturing, development organizations, and then supply chain going out of medtech OEMs. That would be specialty distributions, repair, refurbishment services, but all centered around the medical product. I've been doing this for 20 years at this point, been on DC Advisory for about 3 years, and prior to that spent about 14 years at Baird. I say mostly what we do or what I do in my practice is largely oriented towards sell-side M&A, 100 million to a billion plus. That's sort of the sweet spot in terms of enterprise value. Agnostic across medtech specialties, but primarily focused on what we call cash flow medtech or low to medium tech medtech. Nice to have you guys here. Thank you for your time and participation in our event. Much appreciated.
And what we were going to do from a format standpoint was cover a couple topics and then leave Q&A towards the end. Since we're a little bit more of an intimate setting, if you have a question, fire away. I think it'll be more conversational that way. But really want to talk about and begin our discussion around the current administration's viewpoint on healthcare regulatory policy. I think in many ways, the public equity markets reflected a degree of exuberance, right, when the new administration won. Since then, there's been an evolution, and there's really not a direct signal. There's a lot of noise. So hopefully we'll work to give you some guidance and dispel it. But I'll start with Brian. You're the man on Capitol Hill, among other areas. Give us a feel for what's the general sentiment on Capitol Hill with the new administration and as it relates to healthcare regulatory policy, points of view, perspectives.
Perfect. I'm going to talk in a staccato bullet fashion, and then, we can come back on every point later, but just to get it all out so I don't lecture you all. Not that that's my gig, but... so first of all, remember, Trump didn't really run on healthcare. So you'll notice that kind of playing out already. Healthcare is kind of... We'll talk about the agency in a second, but healthcare legislatively is an adjacent issue. It's not a primary issue. Like, Congress is not debating reforming healthcare. They're debating making some changes to Medicaid, to fund renewing all the tax cuts and then adding some new tax cuts. That's the show this year.
Yeah.
Like if we come back to Congress, for the most part, that's entirely that. There's stuff that is important for healthcare that we'll get to, and a lot of that is a byproduct of other activities. So DOGE, right? Did DOGE up in a lot of healthcare? No. Did they cause some disruption that's probably going to affect the FDA and life sciences in the short term? Absolutely. They were already on the cusp of life sciences quickly. You had a crop of career scientists that were all at retirement age, and they already were starting to retire. So when the new administration came in, you had a wave of them that were like, well, I was going to retire anyway, so I'm out. Then you had some near retirees who were offered the buyout, and they were like, I can't deal with this chaos, they're out. And then DOGE itself had the effect of, when they would lay off a bunch of probationary employees, a lot of those are people who had just got promoted in different divisions within CDC and IH, FDA, and they went back to most of those and said, never mind, you know what, Bob said you were actually really good at your job, so please come back, like 3 weeks later. And they were like, well, no, I actually got a job that I'm making like 2-3x my government salary, so sorry. That's going to have an effect. I mean, the real tell is going to be what like the NME count comes in like at the end of this year. But I will say that obviously the FDA leadership is still very pro drug development. Obviously, they're I think Congress and HHS are still for the most part going to be pro NIH research, setting aside their fight with some of their high profile fights with academia. On the Hill, we're talking about Medicaid. We had to do a lot of hand-holding earlier in the year when people thought nothing was going to happen on healthcare, and then the word Medicaid came up, and there was a giant freak out, and we tried to explain to people, like, well, there's a lot of things they're going to talk about. A lot of them aren't really going to affect your Medicaid assets. So like on sell side, people who were bringing businesses to market, we were like, maybe you should bring it in around July. Mm-hmm. Because the fact is, it's now June, but I was like, by May, you're going to know what the worst case scenario is. Worst case scenario is the House bill. After that, the Senate's going to walk it down a little bit, and like we can bracket that, very easily. Mm-hmm. And it's kind of where we're in that the House has come out, frankly, with Medicaid policy, despite the headlines, is kind of like a G-rated Disney movie. It's a lot less impactful than even what I thought they would start with from a negotiating perspective. They kind of jettisoned the stuff that would really get people fired up right out of the gate. So, we're still, there's still going to be a lot of conversation, but I think the policies underneath them aren't supremely controversial. Mm-hmm. I'm going to pause.
Any questions on that? So I'll ask Aaron, because I think it gels nicely with what we're seeing from an M&A, sell side, go to market, don't go to market, strategy planning perspective. How has the since January to today, everything that Brian was speaking to, the uncertainty and sort of the evolution of it, how is it impacting overall M&A strategy?
Yeah, I think everyone is probably well aware that when Trump initially got into the White House, it was pretty pro-business environment. At least that's what people thought it would be. And I think as sell-side bankers and private equity community, everyone was pretty energized around that potential tailwind to the M&A market. And tariffs kind of quickly slowed things down, and there was just the tremendous amount of uncertainty. And it was folks talking about things like Medicaid and Medicare policy, which in the 10, 15 years of doing this, I've never really had concerns, and folks that I've talked to had concerns about, is there going to be a substantial decrease across the board in, what the government payers are reimbursing? And I think that, put a tremendous pause on healthcare services M&A activity in general. And specific to healthcare services, I think there's a lot of, structural and fundamental headwinds that were also been challenging that market, where having that increased regulatory risk really just put a big pause on what we were seeing in perceived momentum. I think, coming out of, the last couple months where some of that dark cloud has been rising, there's been a little bit more momentum and activity. You're starting to see a lot more books hit the street. But I think folks are still kind of always been saying for the last, 2-3 years, we go to JP Morgan every year, and that's in January, and people are like, oh, the back half of this year is going to be great, and we still haven't seen it yet. I feel good about just talking to folks in general that the back half of this year, I think we have some serious momentum. There's a lot of assets out there that private equity sponsors have owned for 6, 7, 8 years, and they're going to need to transact at some point. I think the CV market, LPs and GPs for that matter, see that could be a solution for some folks, but it's not a solution for all assets. So there is a bit of, dare I say, capitulation going on where those assets are starting to transact from a secondaries perspective. So I think that's really going to be where the floodgates open in the M&A market specific to healthcare services.
Yeah, great insights.
Totally agree with that.
Yeah. Ken, as counsel, what are you seeing from your vantage point? What are things that in this environment you're advising differently in relation to regulatory, antitrust, or anything else for that matter?
No, I mean, I think playing off of some of the themes that we've already heard, I think that there's a tremendous amount of uncertainty. And that means that when you are moving into a transaction, every transaction is scrutinized at a really different sort of degree now than a lot of times. There's really so many of the clients that we work with can't afford to do a bad deal. A bad deal can leave a long history. So there's extra scrutiny in terms of those transactions, whether it's due diligence. The thing that has really also evolved quite a bit is the fact that not only do we have the FTC now, but we have this entire new state attorneys general that are creating their own sets of requirements related to the review of healthcare transactions. And in some cases, those are becoming even more rigorous than the FTC process itself. So on the one hand, you've got FTC, a lot of folks tend to think, well, $126 million threshold, we don't meet that, we're good, let's move forward with a transaction. Well, lo and behold, in Oregon, if you're doing a transaction, they have a 180-day review process. They can ask for anything and everything imaginable. The 180-day review process doesn't start until you have actually completed and they deem it complete. So when you take all the time and expense associated with that, and the thresholds are low. In some of these states, it's $10 million. Well, imagine, anything that you do is probably in excess of $10 million. So
when you say completed, signed purchase agreement.
Yeah. Let's stay tuned.
Sometimes you can base it off of a letter of intent.
Yep.
But I think what we're advising clients now is, I think sort of Scout's motto, be prepared, really understanding the regulatory framework. And that comes in all different forms. It can be from, HSR, FTC, but also, healthcare regulatory, changes of ownership, things of that sort. And so a lot of the time that we're spending is let's make sure that we set the right stage and that everyone has an understanding of what this timeline looks like. And we need to drive to make that timeline as efficient as possible because we know that time kills deals. And so we spend a lot of time making sure we make it as efficient as possible. And we arm our clients with let's do this work to get you in the best position possible, whether it's on the sell side or a buy side.
Yeah. And it's fascinating, the state regulatory pathways and the evolution, because we've known California's it's sort of always correlated to red versus blue states, but I was reading about what's going on in Texas. States that have historically been very pro Indiana. What's your perspective on that evolution?
Well, I think what's happened is that there, and just to set the record straight, there certainly are bipartisan efforts behind the HSR new rules. That was, not, driven by, the Democrats. It really was bipartisan effort. And I think what we're seeing is I think there are a lot of states that are not going to leave it just to the FTC to determine whether or not a healthcare transaction should get approved. And they want the authority to weigh in on those decisions. And I think that's including, red states as well as blue states. Plus there's a lot of, negative publicity out there around healthcare private equity, healthcare REITs. And so you've also got a lot of noise and building angst by a lot of others, creating this even more focused review of healthcare transactions now. So I don't think that, just because Trump got elected, that you should expect that things will just be unwound. I mean, I think that, one, it takes a long time for things to be unwound, and two, there have been bipartisan efforts on a lot of these issues.
Excellent. Any questions from the audience on that topic? We'll shift gears to everybody's favorite topic, tariffs. I never met one I liked. And Manish, as spearheading our efforts across medtech, I mean, perhaps more so certainly than the services where Aaron and I play, give us, how has that evolution affected, M&A perspectives, strategies, and timelines?
Yeah, I mean, it's a very topical question, Hector, so thanks for raising it. Obviously, tariff is a huge unknown, and that has, I would say, pretty significantly impacted any M&A that involved a company that has any exposure to outside U.S. business. And it goes both ways. It's not just a supply chain where companies are importing products from China or Cambodia, Vietnam, wherever, or Mexico, but it's also if they're selling into other geographies. So it's very hard to find a medical product company that is only restricted to buying and selling stuff in the US. There are some models which obviously are in a very advantageous position, but there is a large swath of medtech companies that will have some sort of exposure. So companies that have material exposure, I would say 20%, either 20% of their cost of goods sold coming from OUS geographies, particularly China, which obviously, China is the biggest manufacturing hub around the world. So a lot of companies have that exposure. So if they have that exposure, obviously there is a huge amount of resistance from private equity and strategics to take that exposure on. Mm-hmm. And the worst part of this dynamic is that it's a very sort of fluid, ad hoc policy, right? It's headline driven. There's no sort of consistency, whether it's 30% tariff or 50% tariff, 100% tariff. I think if we have a view that this is the tariff going forward, then as a banker, we can sort of present the financials and P&L to reflect that. The challenge for us and our clients is that they create a P&L under a certain assumption, but it could change by a tweet, right? Mm-hmm. And that has happened to us. I'm actually advising a company that has got sort of 40% of their cost of goods sold actually comes from China. And as you can imagine, like this tariff environment has gone from 30% or so 10% to 20% to 50% to 100% to 145% back to 30%. And
in the middle of the night.
Right, exactly.
A lot of changes to the model.
A lot of changes to the model, and a lot of changes to the model while we are in diligence.
Yeah.
So our buyers, prospective buyers are pushing us, hey, give us the financial, and we give them the financials on a pro forma basis, but then it's changed again.
Yeah.
So that's the challenge of running an M&A process. But from an operational standpoint, these companies that have that exposure are in a sort of big pickle because they're negotiating with their suppliers, creating strategies to move the supply chains outside of China to more favorable geographies, but then the paradigm shifts, right? So while outsourcing or moving production from China to Mexico was a viable alternative when the tariff was 145%, but it's not really that attractive an option when tariffs are back to 30%, right? So it has become a very difficult situation for the companies to operate under, let alone manage a sale process. So it's been, obviously needless to say, that it's been a very difficult undertaking. So what we are basically advising our clients is if they have that flexibility and freedom to put the sale processes on pause and focus on the business, whether it's exit China strategy or some other sort of bringing stuff in-house, like that, those type of strategies. However, I say with that dynamic, businesses that don't have that exposure or they have little exposure to outside US geographies, they are finding themselves in a very advantageous position. So all of a sudden, US-based manufacturing has become really interesting. Right. Even if their cost base is a little bit higher, buyers will pay premium for those assets. Even some OUS, or even some Chinese companies or European companies would love to have a US-based manufacturing footprint. And they're willing to pay more premium multiples for those businesses. So we are advising our clients who are in that advantageous position is to make use of that opportunistic window in the market. Let's get prepared, let's go. Because again, the framework could change. But people generally have long memory, and having gone through this up and down cycle, right, for past 6 months, they are willing to take a bet on the U.S. or make a bet in on the U.S.-based manufacturing, because this is not a short-term thing. And I think tariff is one aspect of exposure to China. There's also China-Taiwan dynamic, right? So even a lot of Chinese manufacturers have come to believe that China invading Taiwan is not a question of if, it's a question of when. So even before the tariffs got instituted, a lot of these actually companies that had that exposure, they actually were working on getting stuff out of China. But regrettably, like a lot of these companies were moving from China to Mexico, but then Mexico got hit by tariffs. So, so a lot of these investments are basically for nothing, right? I mean, there are Chinese suppliers who had built cities upon cities in Mexico close to the border. This was basically looked just like China, right? But it was in Mexico. But now they had to put those plans on hold. Now they think of Africa. We had some clients who are looking at Kenya and other geographies to shift manufacturing. But again, it's always a moving target. Who knows? Like tomorrow, Kenya may be hit by tariffs. So.
Fascinating. Brian, on that note, from your vantage point, the question becomes, when do we see that point of stabilization in tariff policy? And you're so connected on the Hill. What are your points of view generally in regards to, where we go on tariffs from here and when we see that clear line of sight?
Well, I'm going to say something controversial. I think the tariff war's over. There's lots of rhetoric that will continue, but like the basic thrust of the tariff war is over. I mean, the one thing to note about President Trump is that there are people in this room who are ADHD like me, and we recognize him immediately as the most ADHD person we've ever met in our entire life. He's probably like 3 Sigma. That means that his decision-making process is 100% visceral impulse 100% of the time. But that breaks both ways. Yeah, he'll go ahead and tweet at 3 a.m. that we've now have 250% tariffs on China. And then when the market flips out and drops 5% in a single day and then continues for a few more days, all of a sudden he's like, never mind, we're not doing that. We're going to do 10% tariffs on China. I mean, what do we know? We know that Trump hates multilateral trade deals, and he always has. He prefers bilateral trade deals. He's trying to lock down as many as he can, because he's kind of like, bilateral trade deal's great, right? I get what I want, and then if I don't like it later, I just tweet that this deal sucks and we have to talk again. Harder to do that when you're going through the WTO and 50 different countries. The taco trade, I don't know why the taco trade gets under his skin so much. I mean, yes, Trump obviously gets a little raw if he thinks you're making fun of him, but really it's that you're trying to bring in a bunch of these bilateral talks you've had with folk, and taco is just not helpful to that, because you're basically telling China, oh well, go ahead and wait him out, just let's play hardball. So there are areas where the current debate might actually hurt him over the longer term, and maybe with China, just because that one's more existential. But when we were talking about tariffs early on with a lot of clients, I was like, in our own partners working on it, I was like, well, let's just go back to what tariffs are actually in effect right now. Because you've got the 10% ones, but you have a lot that are just we talked about it. Is it really in effect? Not really. In most cases, they're all paused. So I mean, a lot of this is more. I also noticed from Trump 1, there's there's the shock and awe of the opening months of rhetoric, and then eventually and we may be at that point now. The markets kind of come around and they're like, oh, okay. I mean, the taco trade. They're like, okay, I get it. He's going to say a bunch of stuff, and then we're going to cut a deal, and the deal's going to look more like this and not this. I totally agree with Manish, though. I mean, there's certain, I mentioned that in terms of how disruption generally hasn't disrupted too much, but in cases it has. So, like life sciences with staffing, you've got a staffing issue. You've got to restaff. I mean, same thing. Like if you were already concluding from the pandemic and beyond that you needed to like get your operations out of China, how quickly can you do it? Because I mean, this is not an issue that's really cooling down. It's an issue that's kind of heating up, and I don't think the geopolitics of it are gonna, I think it's in all of our interest to not let it boil over, but it's not gonna cool. It's gonna start heating up still.
Mm-hmm. And Ken, how have you seen, from an M&A standpoint, in deal terms and structural elements, has there been a significant change in how folks are underwriting risk vis-a-vis definitive agreements, terms and conditions that you haven't seen in a while and are resurging now? Or
I think that there are a couple of pieces to that. So I think there's one, which is, back to sort of the diligence side and really fully vetting that and understanding from whether it's a supply chain perspective, like where does it start, where does it end, what are the different channels, what are the levers we can pull. We've seen a fair amount in terms of covenants. So having pre-closing covenants that sort of have already mapped out what the expectations are with respect to a seller to mitigate some of those risks that are out there. But you'll see it's really in a number of different ways that it's affecting the transaction. So one is certainly earnouts. At the end of the day, yes, I think we've seen, there are some that are stalling, like wait for a longer period of time. I think there are others, let's see if we can get this done. From a buyer standpoint, the buyer doesn't want to take all the risk on tariffs. On the other hand, the seller also, wants to get as much purchase price as possible. Well, earnouts are a way to sort of say, you have upside here. It is available. It'll be after we've completed these thresholds and you've met the metrics. Mm-hmm. And so certainly earnouts, purchase price adjustments as well. And then I think, some of it is, also we're even seeing it going into MAE, so closing conditions, for example, are you going to close or not close? Now, in some cases, because of the impact of tariffs, but for that sort of interim period between signing and closing, essentially going ahead and saying that, if tariffs hit X, then that constitutes a material adverse effect and the buyer doesn't have to close on the transaction.
Mm-hmm. So really an expansion of what would typically be defined as a materially adverse pain.
Yeah, right? Exactly. And I think that, it's not so much that they're brand new tools that are being used, it's the frequency with which. So certainly I was looking, over 30% of transactions now, that have, tariff implications, have some sort of earnout or other mechanism to mitigate the risk for the purchaser in those instances.
The era of the structured deal is back.
Yeah.
And we'll talk about the era of the preferred return is back too, right?
So many ways.
And I do think that, there are some instances where, the parties are wanting to get a deal done.
Right.
And they don't want to wait. And some of that is much more precision oriented in terms of, it may not be a huge RFP process with 20. It may be, hey, we've identified these 3. Let's go to talk to them.
Yeah.
This is sort of the term sheet that we would expect, and sort of negotiating some of those things on the front end, saying like, hey, we both want to get this done. We got to figure out sort of a way through it. But and that's when the compromise comes into play.
Yeah, great segue to you, Aaron, in terms of what we're seeing in the demand for certainly companies that are well positioned, A-plus quality assets, still transacting, but the demand for sort of differentiated capital solutions, whether it's minority, whether it's structured equity, and what you're seeing in that regard.
Yeah, absolutely. I think there's been a lot of needed creativity in order to provide liquidity and exit opportunities for private equity portfolio companies, as well as founders. Like I was alluding to in my prior comments, there's a lot of portfolio companies in the space that I cover, generally speaking, physician practice management and post-acute provider businesses, where they've been very long in the tooth, and either the providers or the sponsor need to seek, I would say creative ways to get liquidity. So I mentioned before, CVs were pretty popular for a while. I think in, bespoke opportunities, those still make sense if it's a good story, but in a lot of circumstances, they don't. We've seen a lot of work lately with our private capital markets team, Michael, who's in the room here. We've been working on a lot of creative solutions to provide liquidity where potentially majority exit was something that the sponsor initially wanted to do, but it's just not on the table right now due to a lot of market conditions, a lot of what we already spoke of. And you need to, provide a certain constituent of investors, whether it's LPs, whether it's physicians, a way out for some liquidity, and you kind of, dare I say, kick the can down the road a little bit when the story gets a little bit better. So we've been doing a lot of those opportunities with our clients, and I think we're going to continue to see them because, it is a very tough environment still. I wish it wasn't, but it's just the way it is, and that's why you have to work with creative advisors like everyone on the panel here to get deals done.
Yeah. Is that also driving some sort of more out of the box thinking around maybe sponsor to sponsor platform mergers and again more creativity in the market generally?
Yeah, absolutely. So speaking to the physician practice management side of things, over the past decade, there was an abundance of platforms formed in various sectors, right? Call it orthopedics, call it dental, dermatology, whatever. And the question that everyone had in mind is what is the end game in this? And don't get me wrong, a lot of people had great exits and made a lot of money doing those investment opportunities, but I think overall there's probably an overabundance of those portfolio companies out there, and there needs to be a bit of a rationalization of those portfolios. So what we've been helping a lot of clients with is essentially taking a private equity-backed portfolio company and merging with a larger private equity-backed portfolio company where there's a lot of strategic value for the buyer and the seller. Generally speaking, I think from a seller's perspective in that example, the sponsor market really isn't there yet, but the strategic market is definitely there, and we've seen a lot of exits occur, not only for private equity-backed strategics, but even, I would say out-of-the-box strategics like McKesson and other distribution companies where, that wasn't really an option on the table 12, 18 months ago, and now those are buyers in the market that are very active and can do deals and underwrite them at pretty good valuations from what we're seeing. Valuations that we're kind of back at those COVID levels where everyone was very happy about their exits.
Yeah, that's great insights. So shifting gears a little bit and coming back full circle to antitrust and FTC and back to you, Brian. It was fascinating because we all presumed with Lena Khan's exit that we were basically high-fiving each other in the back room. But then the guidance came out that there wasn't really going to be any, at least immediate term, makeshift change in policy from an FTC standpoint. And, how do you see, guidelines, points of view, and perspectives as it relates to healthcare M&A going forward under FTC?
A couple points. One is that there really is no FTC at the moment. You'll notice the one area in healthcare where the sort of bipartisan interest of the commission was, let's look at this. PBMs, the whole case is on pause because they don't have a quorum to even do anything.
Yeah.
You look at the other statements, though. Obviously, when they came in, I don't think they were going to upend kind of Lena Khan's guidance overnight, but I wouldn't be surprised if they tweak it pretty heavily by the time they're done. You'll just notice there are other comments, and I would tie that into kind of the regulatory approach at CMS as well. You have definitely had, it's not a 180-degree shift, but you've moved from prescriptive policy to collaborative policy. Mm-hmm. So already you're hearing both DOJ, antitrust, and the FTC are saying things like, we're rethinking this. We're generally more pro-business. We're going to find remedies that kind of go back to their old school. Like, before Lena Khan, the FTC's long-standing position was settle if we can, only go to court if we must. And she was the exact opposite. She was like, let's be in court every other day because if we're not in court, we're not doing our job. I loved it. I was like, she is racking up. She's putting the FTC in a box through racking up a colossal loss record. but we're in a very different place now.
Yeah.
But I mean, but back to the starting point. FTC at the moment is kind of like not really a commission at all because they don't have a quorum of commissioners.
Is that making some of the larger transactions that would it's just elongating timelines, putting additional pressure on some of the higher profile transactions in the industry?
You want to talk about USAP?
Yeah, I mean, I think, well, I guess there are a couple of thoughts there. I think one is that, talking with members of our FTC team at McDermott and just sort of like what to expect for, the coming days. I think one is anything that was already in process, it's going through its process. There's nothing like, oh, we're tabling all this, and so if it's been in process, it will continue down that review process. I think the biggest change, from what we can tell, is more around some of the things that Brian was saying, and also just enforcement. I think it will be returned back to a time where there was sort of an understanding that there are certain things that are going to be just substantively reviewed because they should be. These sort of wild theories of, oh, well, roll-ups are bad in private equity, and I'm going to try to find a way to, USAP, the USAP transaction, which, ultimately settled, but obviously there was that threat. The whole point was to try and essentially upend roll-up strategies for private equity. I think we'll see a lot less of that, and I think it will be much more around sort of your typical what we knew before review of transactions. I do think that having all of the sort of necessary back to sort of review, using economists, using the tools that you have to best position the review of a transaction, trying to avoid those on the front end that that are likely to already be subject to a second review. And I think we've got a pretty good sense of that now. The other thing too is, I think there will be, fewer challenges that occur. And I think that, what we'll see is something that's much more reliable, which I think we all need. It had gotten to, a point where there was no rhyme or reason as to whether or not, some transactions that were going through, I never in a million years would have thought that they would have made it through without a second request, and others that shouldn't have gotten, pulled, got pulled. So I think a lot of it is, sort of how you position it. But I do think the environment is much more certain in terms of what you should see in the way of challenges.
They might even get back to the one area of healthcare where there is monopolistic behavior, which is, dominant health systems in smaller markets.
Yeah, or how about vertically integrated insurance companies buying everything,
Well, that's a totally different question. We could do a whole day on that, but I mean, that is a question I've asked for like the last 2 years. At some point, I started asking, I'm like, is Optum now like a 1970s conglomerate? Are they too big? Are they at that point where you're going to start seeing them spin off business lines?
Right. Yeah. Well, they are the largest employer of physicians in the United States today. I think upwards of 105,000 physicians. So at some point, it's the same evolution with the conglomerates. At some point, either by virtue of antitrust or they're not realizing those synergies that underwrote the consolidation to begin with, perhaps. Just to share a personal story, I mean, Aaron and I spent a lot of time advising hospitals and health systems, and we've seen that, for the first 10 years of our career in doing so, we were helping them consolidate. Now we're siphoning them off, right? They're divesting non-core regions and properties. I think the same logic applies long term in that regard.
One point I wanted to make before we forget to bring it up was some of you guys probably saw this. It hasn't been reported that widely, but it was in some of the healthcare publications. Back to the collaborative kind of posture now. CMS is about to launch kind of a whole next wave health IT initiative. And the way we know about more details on it was that they had, there's no such thing as a secret in Washington, but they had a semi-secret meeting earlier this week with like a large collective of different people in the healthcare IT arena to basically roll out the idea of where they're trying to go and get feedback on it. So more to come on that. But I mean, that's kind of, I fully expected that. We're starting to kind of see it. Same thing with what CMMI does. CMMI kind of waxes and wanes between kind of the propeller head faction who want to rewrite all of how healthcare works demo by demo, and then nobody wants to participate.
Right.
To the other way to do it is like, say, I don't know, if I want to come up with some sort of oncology bundle, just to invite everybody in and be like, here's what I'm trying to do. How would I actually do that?
Right.
I mean, that's where the dialysis bundle came from. It wasn't CMMI thinking up funky things. It was talk to all the players and be like, how do we do this?
Yeah.
And then we'll write legislation around it.
Yeah, fascinating. Yeah. Who knew? Practical legislation. It's like an oxymoron. It's like military intelligence, But Manish, to round out from the advisory chair, how is FTC antitrust uncertainty, impacting strategic guidance to your clients, timing to market, all things related?
Yeah, I think I agree with Brian and Ken. I think there's generally more optimism about deals not getting blocked by FTC. I think that the level of scrutiny is certainly less, or at least perceived to be less. There hasn't been big sort of medtech merger or transaction that has closed this year primarily for the tariff reason that we just talked about. That has really put a big damper on large consolidation. So there's no proof behind what I said, but I think talking to my clients, there's certainly that optimism that if there were a merger like this, it has better likelihood of succeeding and not getting challenged by FTC and like the previous administration. So I think that's certainly the belief, but it's yet to be proven out.
Yeah. Do you want to add? Please.
I was going to say, I think the other thing just to be prepared for is, with the new HSR rules, there's a lot more information that's being obtained in connection with that process. So we're advising clients, on the front end, before you even start those discussions with the other side, make sure that you have antitrust counsel that's advising you on the front end, so that, you can make sure that, because now everything's basically discoverable through what were 4C documents, basically, the communications between the parties, and that's where you see these huge cases is where there's the smoking gun email.
Yep, the terrible email.
Yeah,
it's always
exactly.
one.
And so I think one, it's going to take longer to do the transactions because there's a lot more information that they're asking. It's also much more detailed information. So, for example, private equity, because we've done quite a bit of work with private equity, in some cases that's asking for a lot of information about the sponsor. And obviously those are some delicate conversations and working with sponsors as to sort of how are we going to approach this. And then I think the other thing too is because they have so much information, it is going to give them sort of better insight into some of the potential triggers for why it could get challenged. So I think you'll have a more reasonable basis for it being challenged, but they will have more information now to make those decisions.
I completely agree with Ken. I think getting the antitrust counsel be involved from the outset, even when we are drafting the marketing materials and memorandums and so on and so forth, we're not sending those out until we've gotten the approval from antitrust counsel. And it's not just for strategic only processes, even for private equity oriented processes, we are having antitrust counsel take a look, because all this stuff, like with access to more information, the FTC can always come up with the argument that this destroys the competition.
Yeah, even the nomenclature used in the offering materials, right, are being scrutinized, like, market dominant position, like those are words that you just don't put it. We used to put it in all the time, but not anymore. But please, Brian.
Higher margins through higher charges. Probably
those are the good days.
Probably not a good document to have. I will bring it back to the sub point we started with earlier, though, is that what keeps Ken and a lot of those partners busy, though, it really is the state level work. Now, here's the good news. Most of the states that have done this, it's a reporting requirement, so that keeps them busy. Lots and lots and lots of reporting requirements. Gavin Newsom vetoed the first attempt at a fairly restrictive "we must approve" type process, which would have really made California in many ways uninvestable.
Yeah.
Watch this week. We got a couple days left on the clock. You guys, if you followed Oregon was like, screw California, man, we're going all the way. So they sent a bill to the governor.
Was that HS 5389 or something?
Yeah, Senate designation, the final one. But
Yeah,
I mean,
yeah.
That one basically makes Oregon uninvestable in
Yeah.
healthcare for private equity.
Yeah, and even bifurcates all the elements that make for the friendly PC MSO structure. It really just drives a stake in the heart of it.
I mean,
structurally.
the question is, does Tina Kotek have common sense that Gavin Newsom did? But I'm a big believer in federalism. It allows us to see states do reforms that work out really well, and it allows states to also try things that are just boneheadedly stupid, and then we can use that as an example of what not to do. So given that Oregon is a pretty small piece of private equity investment, I'm kind of in the position that, well, maybe she should sign it, because then the pure chaos that will unfold in the wake of it will definitely reinforce opponents of this in other states, because Minnesota was also trying basically the Oregon legislation.
Yeah.
Now the election kind of put the kibosh on that, because the Republicans made gains and the legislature is now divided, so it's not going anywhere. But if a state tries it and it's a completely doofus idea, you'll opponents will have a lot of ammo.
Yeah, technical term, doofus, right? Another follow-up question on that is what happens, and maybe it's to Ken, what happens to the private equity-backed assets that are in those states today, right? Basically becomes an illiquid market for those assets. So how do you navigate that?
Yeah, I mean, I think part of that is, is lobby. It will be an interesting. It will be interesting to see. I mean, we've seen this essentially sort of on the precipice, but haven't really seen it sort of fully taken hold. And so I think in that instance, you're talking about potential unwinds.
Yeah. Or maybe grandfather clauses that. Yeah.
And I'll say that, I mean, that's what we have seen before, is just on the, when there's something as controversial as this, I mean, typically what it is it's going to be, here are the sort of exceptions, and advocating for those. But it also probably means for the future, that, you may have an existing business, but, certainly regulators have a way of saying, and now we're completely sort of cutting you off from doing other things. And so they can put parameters around those expectations as to what future business looks like, which, sort of like what they were doing in the USAP deal. So we could certainly see some of that.
Yeah. Well, we're rounding the close to 5 o'clock mark. So I want to leverage our panel's expertise and maybe go down the line, starting with Aaron. Just give us your point of view and perspective on how you see the market evolving over the course of the next year, maybe 12, 18 months beyond, and kind of best practices for navigating these weird and wonderful M&A markets that we're in for healthcare.
Yeah, I think someone said the Cub Scout or Boy Scout model, be prepared. That I would absolutely subscribe to that theory. It's taking a long time for deals to get done right now because of that, but ultimately you can still drive really positive outcomes for good assets and some I guess suboptimal assets as well that are out there. But as I was alluding to earlier, I do think the market is starting to open up. You're kind of seeing a lot of new sectors gain some momentum, and we're pretty excited about that. So overall, yeah, it's still a tough environment out there because of everything we've been talking about, but there is a lot of momentum in the market, and we're going to continue to see a lot of activity for the next 12 to 18 months and beyond.
Okay.
Yeah, I would say I feel like it always takes longer than you think it will for things to turn around. So I'm a little bit more just sort of cautiously optimistic about how things look. We are seeing, for example, in hospitals and health systems, there's a tremendous amount of activity that's happening on the not-for-profit side. In fact, it's a very busy time for consolidation. I think actually some of the headwinds that we see Medicaid included, but just, expenses, cuts to reimbursement, et cetera. Not to mention, I think a lot of those systems have had sort of inflated balance sheets because of COVID and other funds that have sort of buoyed them for years. That this is sort of a time of reckoning for those hospital systems. So I think that we'll see, sort of like we have recently, a number of hospitals that are actually going under. And then there will be, I think, quite a bit of activity for consolidation because they'll be looking around wanting not to be the next one. I certainly hear of, behavioral, we're seeing a lot of activity there. And PPM not as much, but there are definitely med device. I mean, I think you're already seeing pockets that are having transactions post acute. But I would say in terms of like best positioning, I think so much of it is to do a deal these days, you got to get it done right, and to do it right means you got to be smart about it. And I think it gets back to, being prepared, but also being creative too. I mean, there's going to be, whether it's like, let's structure it a different way so we can get through this quicker. Some of those points about like, time kills deals. So finding the quickest way to get to that finish line is going to be key.
Brian?
I'm more optimistic than Ken, but we should break it down. I mean, heading into this year, if people, put a sticky slogan on top of their computer screen, I think the slogan was "Get shit done," because they hadn't done much for 2.5 years, and like I could tell you, I remember like you go back to like 23, and there were some banking teams that I would talk to, and they're like, "Well, we're not seeing a lot of activity, and we're not really looking at a lot of stuff right now." And I get off the phone and with my own career, I'm like, well, by August, that banking team won't be there anymore. So just keep that in mind. We'll track them where they land. But I mean, the general rule is, if you're not doing, you're pitching. And I mean, the banks that are on the cusp of bringing a bunch of stuff right out or are bringing stuff out were ones that all through that were like, what are you doing? I'm on the road. I'm pitching. I'm pitching. And this year I've kind of seen it start to tilt. Like we do a lot of sell side work too, and like if you looked at Q1, like right out of the gate, it was a ton of sell side. But it's like kind of started to come back in a balance where you're getting a lot of buy side advisory work. Another thing on driving that, I mean, we don't need to go through all the details. We all know starting in mid-22, we went through a market reset.
Yep.
And it's like about every 10 years, the multiples get insane, and then finally you gotta like recollect, and then a credit shock just prodded that right along. So that took a while, everybody to get used to it. The people running deals, like there were people in the building who were around in 2006 and 7 and could have told them that the rates were the same back then and the market was perfectly healthy, but when you added inflation to it, there was no one in the building who had any story. They were like, well, our founding partner was back there in the Carter administration, but he's in a nursing home with dementia now. He has no idea. So
He just doesn't remember.
Some of us do remember.
Yeah. But like it was a huge learning process. But the other thing that I think I'm seeing flip, and I mean not to be, Manish can confirm this, and I don't mean it 'cause it's kind of cruel, but like, I looked at a lot of, I did a lot of speeches with some of my banking friends at the end of last year, and we kind of did a market review. And you look at, the last 2 years, everybody shifted away from healthcare services with the high multiples, and they went into pharma services and medtech.
Yep.
But at the end of last year, pharma services and medtech were trading on average at about a 15.5 multiple. Healthcare services had come down to about 11.3.
That's right.
Some of those spaces had big headwinds on them that had to play through. So post-acute, you had 80/20 for personal care. You had the pricing reset with CMS for the skilled side. We're starting to see like the lift off of all of that. So not surprisingly, post-acute picks up. Hospice still very strong. Like DME has been a very strong space.
Yep.
Behavioral, the giant Titanic-sized disaster of the HMS card. That's played through, and underneath it all, ABA was still a good space if you go into it with the right attitude. So behavioral generally picks up, ABA picking up. I see from a lot of clients at the beginning of the year, they haven't changed their posture in that, back to this whole point of LPs want their money. I have a lot of fun clients that were like, so this PPM that we have, we're selling it this year.
Yeah.
They're like, we're selling it in the back half. And you're like, is that a maybe selling it? No, we're selling it. It's 3 years past maturity. We're moving it.
Books written.
Yeah.
So
I think the best quote I heard from a GP was, last year my LPs were screaming at me, this year they have a hitman out on me. So.
But I mean, just even I would say in the last 3 weeks, there's definitely been kind of a shift in your seat back to where they were in January. Was okay. Yeah. All right, I feel better about the chaos. I've realized most of it's like just headline fog. Let's get back to work.
Yeah. Great. Strength to strength, Manish.
Yeah, so from I say my perspective in my sector and in middle market, I think if you sort through all the noise, the market's actually quite good. I think this is the year where the big transaction is probably going to take a little bit of a backseat because of all the complexities we have talked about. But there are many business models in middle market that actually are not impacted by all the tariff and the trade wars. And that has created really interesting window of opportunity for these companies to come to market and transact at the premium multiples. There's enough credit out there. We just ran a process where folks are coming out of very attractive leverage. So the credit markets are supportive. Private equity funds have trillions of dollars, right? That they need to deploy. Strategics have a lot of capital. So from my sector point of view, we think it's going to be maybe not as 2021 robust, but I think it will still be a decent year for us. I pitched 3 companies in the last 3 weeks. Middle market, good businesses, have very little to no exposure to tariffs or sort of trade barriers. And I think these companies will enter the market in the second half and transact at a good multiple. So I think, despite of all the doom and gloom people are talking about, I think it's a very transactable environment, but we just have to pick our spots. Big companies that have very global supply chains and sort of international sales models probably will find it difficult to transact, but companies that have insulated themselves from all this will find a very interesting window to do transactions.
I'm also convinced you just have to hire the best advisors. That's just what I know a few. But thank you everyone for being with us. I'll open it up to questions from the audience, please.
Can you guys talk a little bit about the Oregon situation and kind of this need to approve legislation that's going through, and where's the contagion going from here? How disruptive is that? Is that across the board sectors for all type of private equity, or is it sector specific?
It's pretty much across private equity and healthcare services. I haven't read the language that would apply to anything else in healthcare private equity, but really the core of it's going to be, healthcare physician deals, dental practices, that sort of thing. Like I said before, I don't think this is a contagion. I think this may just be the cautionary tale of if you're a state, maybe not go to Camelot because it's a silly place. Look, Oregon is unique on the West Coast states in that they're, full disclosure, I'm from Oregon. Oregon's obviously the smallest one by population. Oregon's kind of, I know a lot of people complain about Illinois has become like a state where the legislature is owned by the public employee unions. Oregon's been there for a while too.
Yeah. It's the teachers union in Illinois.
In Illinois, in Oregon, it's a lot of healthcare is pretty much concentrated in probably 3 main cities, but you could maybe even argue just one, the Portland metro area.
Yeah.
Very heavy on the public employee front, and so I could see Tina Kotek signing this, and then the question is, does the disaster that will unfold cause them to have to come back and unravel it? Because you remember Vermont got a waiver once to try a single payer system, and I was like, oh, this will be fun.
Yeah.
And sure enough, after about 6 months of designing it, they realized that every single payer in the state was like, if you launch this, we won't participate. And they were like, how about we don't do single payer and we'll just do something else?
Yep.
We could see that, but I before I did this meeting this morning, the first thing I did, before I walked over here was Google whether Tina had signed this bill yet. And then I realized that I think it was sent to her last Thursday. She has 5 business days to decide. but let's see. I mean, Newsom had his head more squarely on his shoulders to the point where he was like, this is going to be an utter disaster, so I'm going to veto this. She could do the same thing. And if she does, I think, bad ideas never fully die, but I think it goes dormant for a while. Because again, if you look at states that were really trying to push that, as you said, contagion, the 3 states in question were primarily California, Oregon, and Minnesota. Again, Minnesota now has an equally divided one of the legislative chambers, so that it's no go there. And Newsom vetoed their version of that bill, so it's all down to Oregon.
Please.
Good ideas coming out of Washington these days that are positive news?
I mean, full disclosure, I work for John Boehner most of my time there, so I'm more of a belief that in the healthcare arena, I usually tell everybody, if you want to know what's really going on in healthcare, you got to get out of Washington and go to the state level. Washington works best when they take that approach. Like, I'm gonna weigh in with opinions here that I'm not gonna direct. Part of it's also, if you've ever watched a congressional hearing, the nature of congressional hearings, like if you're like, I would like to hold a congressional hearing to talk about the state of healthcare in the world, and the hearing is like MedPAC, XYZ professor from big academic teaching hospital, XYZ person from big academic teaching hospital, one more, and then I don't know, maybe somebody's from a budget think tank, and I'm like, that's a horribly skewed panel, and they have no idea what's going on in healthcare out of like the Cleveland Clinic.
Yeah.
So yeah, like Part D is a great program. Medicare Advantage is a great program. They primarily work because it's a government partially finances it, and they have nothing to do with really running it, except for some guidelines that are negotiated every year, and that's how Washington works best, in my view. Oh, and also those programs sell directly to the end user, not through a third party.
Yeah.
I should mention, we do have a heat map on our website that shows, as we talk about these various states and sort of the evolution of the requirements. So it's a great tool. A lot of our business people use it because it gives you sort of real-time information in terms of which states to look out for.
That's great.
Yeah. I'll add that no one in the McDermott family does this directly, but we definitely talk about it a lot. There are coalitions out there primarily set up by the AIC, the Investment Council, and they've done a pretty good job of creating a lot of state-based advocacy groups, which is how Oregon got killed the last time. Also, I think that weighed heavily in California's calculus and in other areas. But the next phase of that is as much of a communications project as it is a lobbying project. I think they're pretty good on the ground on the lobbying, but I mean, really, somebody pulled some slides for me today that clearly AI wrote for them, and I was reading it and I was like, this is absolute garbage. It was like, it was a slide that was talking about private equity concerns, and it had like definitive statements like, private equity investment in healthcare produces worse outcomes and equivocal this and bad that, and I'm like, these people private equity firms can't go out there and run the ad campaign themselves. They can't be like, this ad brought to you by KKR. Healthcare is great and we're investing in it. But the companies that you own, they have to do a better job of telling their story. Better customer service, better access, at least equal outcomes,
Better compliance.
Mm-hmm.
Yeah.
Infrastructure. Yeah.
And back to Manish's point earlier, I mean, a lot of our deals in a year are very much firmly in the middle market, and I do think middle market private equity generally works out well most of the time in healthcare because it's a very hands-on, very collaborative process. If you look at the nasty Bloomberg hit piece, the nasty New York Times hit piece, not to be mean to anybody in this room if you qualify, but it's like usually my large cap clients where they did the deal and they immediately moved on to the next deal, and there were no hands on the teller, and there wasn't a lot of cooperation on the asset that they now own.
Yep.
And then all of a sudden, some implementation bomb blows up in their face, and they're like, where did this come from? Mm-hmm. You're like, well, you could have seen it coming if you were there.
Yeah. Yeah. Well said. Well, thank you to our expert panel. Thank you for all of you being with us. I am never one to get between you and your martini, so have a wonderful time at DC Fest. Thank you for being here.
Yeah.